In September 2008, the global financial system came terrifyingly close to stopping. Banks no longer trusted one another. Credit vanished. Businesses struggled to borrow, families lost homes, and millions of workers lost jobs. The crisis began in American housing, but it changed politics, money, and daily life across the world. To understand it, start with a simple promise. Home prices would keep rising. For years, low interest rates, easy lending, and intense demand for mortgages encouraged banks to make more loans. Some went to borrowers with weak credit or payments that would rise later. These mortgages were bundled into securities and sold to investors around the world. The structure seemed to spread risk. In reality, it often hid it. Rating agencies gave many mortgage-linked products strong grades. Banks borrowed heavily to hold them. Insurance-like contracts appeared to protect investors from losses. As long as homeowners kept paying and prices kept climbing, the machine generated enormous profits. Then house prices stopped rising. Borrowers began missing payments. Mortgage securities became difficult to value because nobody knew how many loans inside them would fail. Institutions that had looked powerful were suddenly exposed as highly leveraged and dependent on short-term funding. In March 2008, Bear Stearns collapsed and was sold with government assistance. That should have been the final warning. 6 months later, Lehman Brothers filed for bankruptcy. Its failure sent panic through the system. Money market funds came under pressure. Companies feared they might not make payroll. International trade slowed because banks hesitated to finance shipments. The crisis was no longer about bad mortgages. It had become a crisis of trust. Governments faced an ugly choice. Let failing institutions collapse and risk a second Great Depression, or rescue a system whose behavior had helped create the disaster. The United States created the Troubled Asset Relief Program, known as TARP, to stabilize banks. The Federal Reserve supplied emergency loans, cut interest rates towards zero, and later purchased large amounts of government and mortgage securities. Other central banks took similar steps. These actions remained controversial, but they helped stop the financial panic. They did not stop the human damage. From late 2007 through 2009, the United States lost millions of jobs. Foreclosures tore through communities. Household wealth fell. Young people entered one of the weakest labor markets in generations. In Europe, banking losses became entangled with government debt, producing years of austerity, unemployment, and political anger. The recovery also changed how people viewed fairness. Large financial institutions survived with public support, while many families received far less help. Executives kept fortunes accumulated during the boom. Homeowners could lose everything after missing a few payments. The phrase "too big to fail" became a symbol of a system that protected institutions because their collapse threatened everyone else. Reform followed. The Dodd-Frank Act imposed new rules on American finance. Banks were required to hold more capital and undergo stress tests. Consumer protection strengthened. International regulators introduced tougher standards. The financial system became more resilient in several ways, but risk did not disappear. Some activity moved outside traditional banks into private credit, investment funds, and other parts of shadow banking. The crisis also transformed monetary policy. Near-zero interest rates and quantitative easing, once emergency measures, became central features of the following decade. Cheap money supported recovery, but it also lifted asset prices and rewarded people who already owned property and investments. Housing grew expensive in many places. Governments and companies became comfortable with low borrowing costs. The response to 2008 helped create the financial world that existed when COVID arrived. Politically, the effects were even wider. Trust in experts, banks, and governments fell. Movements on both the left and right gained strength by arguing that the economic system was rigged. The crisis influenced elections, protests, trade debates, and attitudes toward globalization. Its anger did not fade when stock markets recovered. The deepest lesson is that a financial system can appear stable while becoming fragile underneath. Risk was not eliminated by clever securities. It was distributed so widely that almost everyone depended on the same assumption. When that assumption failed, private mistakes became public emergencies. The 2008 crisis changed the world because it changed what governments were willing to do, what central banks were expected to prevent, and what ordinary people believed about the fairness of capitalism. The panic ended, but its consequences never really did. Today's housing costs, political divisions, bank regulations, and debates over bailouts all carry its fingerprints. The next time a boom is described as safe because risk has been spread around, remember 2008. Sometimes risk that seems to be everywhere is not harmless. It means everyone is standing on the same cracking floor.